Picture this. You finally decide to do the responsible thing. You start saving money. Every month you set aside a little from your paycheck. Maybe it's $100. Maybe it's $200. It feels good. You feel responsible, disciplined, and financially smart. But one day you open your banking app and notice something strange. You have $10,000 sitting in your savings account, but it's only earning about 0.5% interest. After an entire year, you've made just $50. Meanwhile, everywhere you look, people are talking about investing, stocks, index funds, and compound growth. Suddenly, you start asking yourself, wait, am I doing this wrong? Here's the truth. Saving money is important, but saving alone rarely creates real wealth. And this is exactly where most people get stuck. They know they should save, but they don't know how to make the transition from saving to investing. So in this video, we're going to walk through a simple, step-by-step plan that will help you move from saving to investing without feeling overwhelmed or putting your financial security at risk. My name is Jack. If you have money sitting in a savings account but aren't sure how to start investing, make sure you subscribe to the channel and give this video a thumbs up. Now let's begin with something that might surprise you. Saving money alone will almost never make you wealthy. Don't get me wrong, saving is essential, but it's not the finish line. It's only the first step. Because saving and investing have two completely different jobs. Saving protects your money, investing grows your money. Let's look at a simple example. Imagine you have $10,000 in a savings account earning 1% interest. After 1 year, you'll have about $10,100. Now imagine that same $10,000 is invested. Historically, the S&P 500 has returned around 10% per year on average over long periods. At that rate, after 1 year, your money could grow to around $11,000. At first, that difference doesn't seem very impressive. But the real magic isn't what happens in 1 year. It's what happens over time. That's the power of compound growth. After 20 years, money sitting in a savings account earning 1% grows to about $12,200. But money invested at an average annual return of 10% could grow to roughly $67,000. Same starting amount, completely different ending. This is why the biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. So why don't more people invest? The answer isn't math, it's psychology. Saving feels safe. Investing feels risky. Money in a savings account doesn't go up and down every day. But investments do. Some days they're up, some days they're down, and those fluctuations scare a lot of people away. Maybe you're thinking, but I don't want to lose my hard-earned money. That's a completely reasonable concern, and that's exactly why moving from saving to investing should happen gradually, not all at once. Let's break it down step by step. Step 1. Build an emergency fund. Before you invest your first dollar, make sure you have enough cash saved to cover 3 to 6 months of living expenses. This money stays in your savings account. It's not for investing, it's not for opportunities, it's there for emergencies, job loss, medical bills, car repairs, unexpected expenses. Because one of the biggest reasons people panic and sell their investments is that they need the money too soon. An emergency fund protects your investments from life's unexpected surprises. Step 2. Mentally separate saving from investing. Think of your money as two different buckets. The first bucket is your safety money. The second bucket is your growth money. Your safety money stays stable. Your growth money is allowed to move up and down because its job is to grow over time. Making this mental shift can dramatically reduce your anxiety. Step 3. Start investing with a small amount. Many beginners think investing requires thousands of dollars. It doesn't. Today, many investment platforms let you start with as little as $50 or $100. Your goal isn't to get rich overnight. Your goal is to build the habit, because habits matter far more than perfect timing. Step 4. Keep your investments simple. This is where many beginners make a costly mistake. They jump into day trading, options trading, or speculative cryptocurrencies. But simple investments often outperform complicated ones. A great example is index funds. Instead of trying to pick individual winning companies, index funds allow you to invest in hundreds of companies all at once. That gives you diversification, lower risk, and strong long-term growth potential. Even legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors. Now, here's something many people don't realize. The most powerful investment strategy is actually pretty boring. It's called consistent investing. Let's look at another example. Imagine you invest $300 every month. If your investments earn an average annual return of 8%, after 25 years, your portfolio could be worth around $285,000. The amazing part? You only contributed about $90,000. The remaining $195,000 came from investment growth. That's compound interest working in your favor. But psychology still plays a huge role. Because investing isn't always comfortable. Markets rise, markets fall. The news becomes dramatic. People panic. And that's where the difference between investors and gamblers becomes obvious. Think about it like this. Saving is like keeping a bag of seeds safely on a shelf. They're protected, but they never grow. Investing is like planting those seeds in the ground. At first, it doesn't look like much is happening, but over time, those tiny seeds can grow into something far greater than you ever imagined. Now, you might be wondering, what happens if I start investing and the market crashes? Great question, because market crashes are completely normal. They've happened many times throughout history, but long-term investors often see market downturns as opportunities. Why? Because when prices fall, your regular investments buy more shares. And when the market eventually recovers, those extra shares can create even bigger gains. That's why experienced investors don't panic during market declines. They think in decades, not days. So let's quickly recap. First, build an emergency fund covering 3 to 6 months of expenses. Second, separate your money into safety money and growth money. Third, start investing with small amounts consistently. Fourth, stick to simple long-term investments like index funds. And finally, stay patient. Give compound growth enough time to work. Remember this, saving gives you security. Investing gives you financial freedom. The sooner you combine both, the stronger your financial future becomes. If this video helped you understand the journey from saving to investing, don't forget to subscribe to the channel. And I'd love to hear from you. Are you still in the saving stage, or have you already started investing? Leave your answer in the comments below, because the moment your money starts working for you, your financial future begins to change.